Good afternoon, everyone. I am Bonnie Sussman, partner in the Financial Services Group at EisnerAmper. I am pleased to introduce today's panel, the LP's perspective in the COVID-19 environment. Today's panel will discuss their top-of-mind considerations in the current environment and how general partners can reevaluate their own investment, financing, and key business processes to reassure LPs amid COVID-19 concerns. If you would like to submit questions to the speakers, please use the Q&A widget, which will also direct you to live tech support.
Thank you for joining us at our summit today. We would like to welcome all of you to today's limited partner panel discussion. First and foremost, we hope you and your families are safe and well. My name is Tony Minifort, and I'm a partner in EisnerAmper's financial services practice. Today, we will be discussing limited partner perspectives on key topics as they operate in the COVID-19 environment. A quick reminder, please submit your questions at any time in the Q&A widget on your screen, and we will do our best to address the questions at the end of the panel if time permits. The Q&A can also be used for live tech support. First, let me welcome Irina Gershengorin, partner in EisnerAmper's financial services practice, who will be asking the audience questions for the panel at the end of the discussion. And now I'd like to welcome our panelists. Today we are joined by Jennifer Choi, Managing Director of Industry Affairs at the Institutional Limited Partners Association, ILPA. Marcy Heidel, Managing Director of Performance Equity Management, an investment firm based in Greenwich, Connecticut. And Wes Bradle, Senior Portfolio Manager at the Florida State Board of Administration. I'd like to thank all of our participants for joining us today. And now let's dig right in and kick off the discussion. So back in March, when COVID-19 came upon us, there was a lot of discussion in the media about the limited partner community, how they would respond, and would there be liquidity issues, would capital calls be honored? People were really worried about what the environment was like. Here we are 6 months later. Exits are still slow in the private equity world, but things seem different. So it would be great to hear from each of our panelists what their views are on the current state of affairs, limited partner liquidity, and the overall environment to be an investor in today's world. Marcy, why don't we kick it off with you?
Thank you, Tony. What a difference 6 months makes. I agree with you. Back in March, things looked really rather bleak. And if you think about it, since year end, we've had 2 quarters, and I think we're about in the same place we were at the end of Q4 2019. Our portfolio declined probably in the high single digits, mid to high single digits for Q1. But then I think the public markets and performance of a lot of the tech portfolio help us get back up probably closer to 10% for Q2. So we're about where we were at the end of the year. So I would imagine that we're not that different than a lot of other portfolios out there. So I don't see anything in the near term that is going to cause liquidity constraints. I think the question is, how long does the lockdown from COVID last? And how severely are some of the underlying portfolio companies impacted? And then how creative our managers can be about getting into new companies and exiting their existing portfolio companies. But right now, if we took a snapshot of contributions versus distributions through first half of 2020 versus first half of 19, and contributions are down 29%, whereas distributions are down 17%. So with that in mind, I don't see LPs becoming very overweighted anytime in the near term unless there's some exogenous factors, like if the public markets move down again rather quickly and dramatically, then that could potentially cause some problems. But I feel like we're in a good place right now as an LP community. I think our GPs are being very disciplined. Our portfolio values have held up. So I'm feeling a little more optimistic than I did at the end of March.
Jen, you hear a lot from the LP community. What other thoughts have you been listening to?
So we too expected that there were going to be some liquidity pressures for our members. We represent 550 institutional investors into private equity across 50 countries around the world. And we were expecting to see some of those liquidity pressures manifest, especially as we saw across the board a surge in capital calls in the first quarter in the early days after the onset of COVID. For some of our members, it was capital calls of a quantum at historical levels. But what we found was that, by and large, LPs really did take lessons from the GFC, and most had put in place this sort of flexibility in how they manage their allocations relative to the balance of the portfolio, how they manage against a target. Liquidity, a number of LPs have indicated they've even put in place their own lines of credit. So they had done the sorts of things to insulate themselves from liquidity pressures or forced selling in a down market that you might have expected to see. And to echo Marcy's point, the impact on portfolios, while projected to be pretty severe, didn't manifest. We've been asking questions of our members, or at least it hasn't manifested to date, I should say. We've been asking questions of our members, how much have valuations really moved? And the last we asked this question, the last time was in June. And what we found at the time was that 60% of the LPs that we surveyed, and this was a few hundred LPs at the time, said that their valuations had only moved 10% or less. So they hadn't seen huge swings in their portfolio. Of course, that would look different depending on whether you had more exposure to some of the sectors that were hardest hit. But in large part, I think the way in which this crisis is playing out is entirely unique. Something that started as a global health crisis and has translated into broader economic impacts, but we have not yet seen that manifest in LP portfolios as severe liquidity constraints, and LPs seem to have been well prepared for the advent of such a possibility.
Yeah, so Tony, I would say, similar to Marcy and Jen, things were tough 5 or 6 months ago, and obviously things have rebounded pretty quickly. I mean, I think in general, there are just some broad economic factors that impact liquidity, which then impacts confidence. So things like, when you have negative GDP growth, when public markets are down, when treasury spreads are widening, things like that, right? It's hard to make new commitments. But with the Fed stepping in, liquidity all of a sudden became available, public markets went up, and LPs became confident again. So I think for LPs to default on capital calls, we would need to see a sustained downturn of somewhere between 6 to 12 months, which is what we saw in the global financial crisis. But, with coronavirus, the rebound was just so quick that it didn't really materially impact LP liquidity.
So 6 months later, things are better than we could have hoped for, frankly, in mid-March when everybody started working from home. We're all in the business of also evaluating risk. Where today, though, is the risk? Is it around how the Federal Reserve will continue to provide liquidity? When you look at your portfolios in the macro environment, where should we be concerned? Wes, maybe you can take that one to kick it off.
So yeah, Tony, I think in addition to what I previously mentioned, I think we also have to think about LPs as a counterparty, and there's different kinds of counterparty risk depending on the LP. So, if you think about high net worth individuals, right, they tend to lever up in really good times, but when markets turn, they face margin calls, liquidity evaporates, which can lead to capital call defaults. You have foreign LPs who, if they're investing in US dollars and their local currency becomes liquid, they may default. I actually heard about a private equity fund that had a large LP in China, and that LP couldn't fund a capital call because they couldn't convert RMB to US dollars because of capital controls in China. You have hospital systems and healthcare endowments who faced a lot of pressure as COVID hit because revenues decreased. As we know, things rebounded quickly, but if we saw a second wave, that could pop up and have a negative impact on healthcare and hospital systems. If charitable giving is down, that's going to hurt liquidity for university endowments. I don't know if you saw this, but the Big Ten canceled all fall sports. I think most people know that. But I was reading how Michigan went from $1 million budget surplus to a projected $26 million deficit. I heard that Ohio State's going to lose something like $110 million in revenue from the cancellation of football. So you got to think that that could impact their endowments in the future. And I think for us, look, if tax revenue is down, it's going to hurt liquidity for state pensions. And so, that's going to impact our future commitment decisions. And so, outside of a 2008, 2009 scenario, I think LP liquidity issues are going to be dependent on the market conditions for that specific type of LP. And I just want to point out that in each of these categories, the higher risk LPs, the ones typically with large asset liability duration mismatches, they're going to be the first ones to have issues in a sustained downturn. So if you're a public pension that's 10%, 15%, 20% funded, you're much more likely to default on capital calls before a pension that's 80% funded. And I think this is why it's important for private equity funds to make sure they have high quality limited partners, and also why it's important to properly diversify their LP base by type of LP, so that if one type of LP has issues, that doesn't affect the entire fund.
Marcy, what are your thoughts on risk in September here?
I tend to agree with Wes. I think we need to see a sustained period of downturn. And I think it could be a recession, but I also think you need that to be combined with a freezing of the capital markets, because as long as the capital markets are functioning, I think institutions will find a way to make good on their capital calls. And we'll probably talk about that a little later, but I mean, it's pretty punitive to default. So I would expect that what you would see if we would reach a situation like that is fundraising would slow, pace of commitments would slow, but LPs are really they're very sophisticated. And I believe that for the most part, LPs would continue to commit because everyone really has the information that shows you the vintage years following a crisis are some of the best performing vintage years. And as everyone here knows, you can't really time that. If you're committing to a fund right now, or even you committed last year, they may commit during some of the best times, even though there may be a slight bit of capital in the ground from something you committed to last year. The following few years may be fantastic years to invest in. So I think you would really have to have close to a GFC to see folks really pull back.
Jen, are you hearing similar things from the broader LP community?
So I think that what Marcy and Wes have already pointed out is consistent with what we're hearing across the spectrum of members. But I would add, and it's not so much a macro risk here that might change behavior, but I would add the observation that there's also a risk in the near to medium term where LPs are primarily focused on re-ups, managers that they already knew pre-crisis, because for the most part, LPs are not yet making new commitments to managers that are new to them, where they haven't had the benefit of an in-person meeting in the past. And so it does beg the question, what kind of a deal are LPs getting in this environment where there's a flight to the familiar, whereas we saw a flight to quality in the GFC. And I don't think we've yet seen materialize the kind of gains in the quality of alignment of interest between LPs and GPs that we would have expected in more of a supply-demand imbalance in the market where LPs might have gained a bit of an advantage in negotiations. That's not happening yet. And we certainly saw, quality managers really get to accelerated closes, and many were even oversubscribed in the very early days after the onset of COVID. So it's not so much an observation on the macro risks that LPs are talking about, but it's certainly top of mind as LPs are still keen to put money to work, as Marcy said, to not waste a good crisis and to take advantage of some of those opportunities to deploy capital right now. Yeah,
so just one other thing I would add is that I don't think these these things are predictable. If you look at something like 9/11, or you look at something like the global financial crisis or coronavirus pandemic, it was very, very difficult to predict these things would come. So I think it's important for LPs to prepare for when liquidity tightens. But I think it's important also to know that that could be tomorrow, but that could be 5 years from now.
Thanks, Wes. On a related topic, let's shift gears somewhat. The topic is subscription lines of credit. They've gotten an enormous amount of attention in the media in recent months and years. I see it almost every day. Would love to hear from the panelists what's driving their use, and the different factors that are coming into play with their prevalence. So, Marcy, maybe you can start the discussion on this.
Yes, they have received a tremendous amount of attention. And, if you go back to what I could call the good old days, subscription lines were used primarily because GPs had a smattering of investors that didn't like to have frequent capital calls. Or a GP, especially if you looked in the distress space, they were more opportunistic, and they may not have time to call the capital that they needed to take advantage of a nice investment opportunity. Fast forward to today, there was a movement initially to minimize the J curve. And I think that's a good thing. I'm all for minimizing the J curve. But now I think it's really been used more broadly because GPs are looking for a way to get a boost on their IRR. It's a temporary boost. We all know that. As you put more money in the ground, the advantage that you have from the subscription line diminishes to where there's still a slight advantage toward the end of the commitment period, but it's certainly not the kind of couple hundred basis points that you see in the beginning. But I think it's that is really driving the popularity now in terms of increasing your IRR early on. And when you go to raise another fund, it looks very attractive, potentially relative to the benchmarks. So hopefully that's helpful.
Wes, do you see similar things in your organization?
Yeah. There's definitely a few reasons. I think number one, it's just easier. So fewer capital calls makes everyone stay more efficient. Number two, there are a lot of LPs who are compensated on IRR, and subscription lines in up markets definitely improves performance for underlying private equity funds and then for the LPs who invest in them. Number three, I think for the GPs, it's a little bit like steroids in baseball. Once a few people are juicing, everyone feels like they need to do it or they'll get left behind. And I don't think any GP wants to hear that they moved from second quartile to third quartile because they didn't use a subscription line and their competitors did. So I also think, subscription lines leads to a shorter J curve. And there's also a higher probability that the fund hits the hurdle rate and the GP earns carry. And then on top of all that, interest rates are low. So I do think if interest rates rise, subscription lines will likely either shrink in duration in terms of in duration or in terms of the capital that's on the line. And I would just add one other thing, which is it relates to fund level performance. And that's, for us, we do look at a fund's performance relative to a benchmark, but we also look at a fund's performance compared to a public market equivalent. And so if you're a fund that makes an investment at the peak of the market and use a subscription line, and then you don't call capital until public markets have gone down by 10% or 20%, when we run the public market equivalent, it's going to show you calling capital at a low point in the market, even though you bought an asset at the peak of the market. And so this may cause a fund to underperform versus a public market equivalent and lead us not to not make a commitment in the next fund. So, a lot of people talk about the performance benefits of subscription lines, but I think it's important for GPs to understand how the lines can negatively impact performance, and then make a decision based on both the benefits and the risks or the concerns.
Interesting. Jen, could you also comment? But one other consideration I've been thinking about: to what extent is also the lending community playing a role in that? I assume they're developing some more sophisticated products to market to those seeking subscription lines. There are other players in the marketplace, I would think, that have a role in their increased use.
That's absolutely right, Tony. I think the lenders play a role here, and the latest estimates I've seen, we've got about 70 lenders actively participating in the subscription credit facility space. Big Five kind of dominating a lot of the volume there, but with the low interest rates that Wes pointed to, it's become a very attractive market in which to sell to the GPs. And certainly, I think the point about keeping up with the Joneses, making sure that you're not artificially being pushed down in the benchmark standings simply by virtue of the fact that you're not doing what everybody else is doing, has helped feed the sales pitch from the lenders. I'm not looking to paint them in an excessively negative light. I think all of the factors kind of point to this being, leading up to this point anyway, a pretty benign environment to tap into that interest among the GPs. And they have been innovating the NAV-based facilities, which are really securitized not by the unfunded commitments or the uncalled capital, but rather the assets in the fund, is something that is growing. It's still a minority of the market overall, but it is a growing part of the market. And I will say, during the coronavirus era, we're also starting to see some of that innovation creep into the commitment facilities themselves in terms of how the lenders are evaluating the risk of those facilities and the types of covenants that they're introducing into those lender agreements with the GPs. And namely, in some cases, and I don't have a number to give you on how prevalent this is, but in some cases, having that theoretical additional means of understanding the risk attached, tied to the NAV in the fund itself, the money that's in the ground, as a measure of how compelled will LPs be to continue to fund future capital calls? And part of that will be a function of, well, how much value do they already have in the ground that they risk losing? So there are definitely some innovations taking place that the lenders have tapped into, and the GPs seem to be keen for more creativity in the fund finance space.
Thanks, Jen. Is preferred equity also one of those innovations? I don't recall seeing that phrase, fund level preferred equity, until recently.
Preferred equity is definitely something that we've really only seen take shape over the last several years. There are a couple of fairly well-known GPs that specialize in that space, but as far as the lending community jumping into preferred equity, I think it's still a very, very small part of the overall fund finance market. And frankly, not something that LPs seem to be terribly excited about, as it can introduce, potential conflicts of interest. You're splitting the economics from the fund across more players beyond just the LPs and the GP. So a small but perhaps emerging part of this space that LPs are paying attention to, but maybe not crazy about just yet.
Thanks, Jen. So on a related note then, and we touched on IRR earlier in talking about subscription lines of credit. If we could just elaborate on this topic a little bit. It's also lots of topics getting attention in the media, but this one has again is getting elevated discussion around best practices in measuring a fund's performance. I'm sure due to the increased use of debt, it would be great to hear some comments on what your views are in the marketplace as a panelist, and what you view as best practice or concerns too on how managers measure their performance. Marcy, maybe we start with you.
Yeah, I think the biggest challenge right now is that as far as we can see, the benchmarks don't distinguish between a fund that has used a subscription line or even use something that's like the NAV loans and just a plain fund that has handled capital calls traditionally. So you can get a boost, and it's not clear that it's coming from debt. Having said that, again, I'll go back to, I think the LP community is very sophisticated, and LPs are evaluating their GPs at a gross level and a net level. We understand who's using a subscription line. Many GPs report on a regular basis their IRR without a subscription line and with the subscription line, so that we understand the impact that a subscription line has had. I think there's also another issue that we haven't really talked about, and it's somewhat related to performance. But if you are boosting your IRR in the earlier years, you could potentially hit your preferred return earlier, more than likely you would, than you would under normal circumstances. And it could create maybe a bit of a misalignment between LPs and GPs. I mean, we'd like to see that you kind of earn your way to the hurdle and minimize the risk of a clawback, which all of our LPAs have clawbacks, so we are protected there. But we don't really like to have that conversation. So I think introducing a subscription line also may raise the risk that you'll be in a clawback situation.
Thanks, Marcy. Wes, do you see similar things in your organization?
Yeah, we do. I think, as Marcy said, the benchmarks don't factor in leverage, so we just sort of assume everyone's using it. I would say in terms of best practices, I mean, reporting IRR on a levered and unlevered basis, first of all, when you send us a pitch book, when you come in to make a presentation, I think that's definitely best practice. And I would say secondly, quarterly disclosures of levered and unlevered IRR is also something we're seeing more and more of. And then in the financial statements as well, just the terms of the facility. So things like the size, the duration, the interest rate, that allows us to calculate our total exposure across all funds as it relates to subscription lines. The last time we did that exercise, it was about 10% of our unfunded, or $600 million, were on a line. And so again, that's important to understand. If markets turn down and the liquidity is drawn down quickly, you're going to have to be able to fund all those capital calls. And I know Jen can probably hit on this, but I know ILPA also has an initiative on reporting practices as it relates to subscription lines.
Thanks, Wes. Jen, definitely, we'd love to hear ILPA's perspective on this. We know the organization's been vocal.
Yes, Tony, we've absolutely, as Wes said, taken a strong position that LPs really do deserve a lot more transparency into how these facilities are impacting on reported IRR, and shouldn't just be because you push the question when evaluating a pitch book or during a fundraising discussion, or you're forced as an LP to ask for this disclosure on a quarterly basis. One of our members recently shared that they've inserted a requirement in their side letter that they will not invest with any GP that won't commit to providing that levered and unlevered performance information at quarter end every quarter, which I think is probably towards the end of the spectrum as far as what LPs are pushing for. But I'm delighted to hear that both Wes and Marcy are getting this information, and we think that this should be coming to all LPs. I just point to the exposure issue that Wes raised as well. Right now, because this information is not being presented in a consistent fashion to the LPs every quarter, they're having to back into what that exposure, what is outstanding on the facility relative to their unfunded, so that they can come up with a true picture of what they have on the ground and what has yet to be called. And so earlier this year, we did issue some recommendations both on the performance point, but also on providing LPs with that exposure data so that they wouldn't have to be trying to stay on top of that in a very manual manager by manager basis. We didn't see this with the onset of COVID, where people were in a liquidity crunch. I think that was the fear and the expectation that all of these lines were going to get paid down at once, and you'd suddenly have to satisfy far more volume in terms of capital calls than modeled for. Luckily, we didn't see that come to pass, and LPs were prepared. But having that information in hand really does mitigate a lot of the risk associated with use of these facilities, particularly in light of the fact that it's become such a mainstream feature of how the industry operates today.
Great comments. Just one follow up to anyone on the panel. Feel free to jump in. And maybe it's the auditor in me, but just do you see? I assume you see situations where managers really push the envelope in terms of how they present performance, and you see it jump off the page, and I know those are probably the ones you then don't do any business with. I love stories if there are any to share.
We do see some creative presentation of performance, and obviously it's mainly in the pitch books that come across. I would just say I don't have a specific story to share, but it's really a bad idea because trust is a big factor in an LP's relationship with a GP. And I think a GP can explain performance, but explaining why you tried to have performance look a certain way that is not considered industry standards is a lot harder. And I agree with the other panelists that we do really need some consistent standards around how performance is presented with the subscription lines.
Yeah, so Tony, one interesting story, we had a secondary fund that used a subscription line and ended up getting a distribution before the fund ever called capital, which creates an infinite IRR. We've also seen other secondary funds come in with 1,000% plus IRRs. But I think to Marcy's point, your most recent fund, it's usually a couple years old, and whether it has a negative IRR or a 2% IRR or 1,000% IRR, those valuations can change dramatically over the coming years. So we always tend to discount the most recent fund.
I'd like to leave enough time for Q&A. I'm sure the audience has a lot of good questions to ask. I want to thank everybody. I'm going to kick this over now to my colleague, Irina Gershengorn.
Thank you, Tony, and thank you, Jen, Marcy, and Wes. This was really informative. We have some questions coming in, and I'm guessing that as we go through these, we're going to run out of time. So here's the first question. Is it challenging being a new manager and seeking LP commitments in the current COVID-19 environment?
Yeah, I think it is challenging for new managers to raise capital in this environment. I believe that people are having a lot of first meetings. I mean, Zoom is an incredible tool. It enables us to have the first meeting, but I do think there is a bit of a rapport that people establish when you're in person and can allow you to take it to the next level. Well, we have committed to a couple of new managers during this period. I have to say one of them we had prior experience with at an old firm, and that made it a lot easier. We knew people he used to work with. We knew people his staff used to work with, and that minimizes some of the discomfort that one might feel. For a new manager that we have no point of contact with prior to COVID, no in-person meetings, I think it just takes a lot longer, and we're willing to do the work. I do think it's a lot more time consuming because what we have had happen in our shop, and I'm not sure what's going on with you, Wes, is I thought I would have a lot more time because I'm not on airplanes any longer. But what has happened is it feels like I'm almost on every Zoom call that we have, and we have a pretty robust staff here. So that's a lot of meetings. So I think you have all of the partners here are coming up with, each of us have ideas about what would be great for our portfolio. So there's maybe even a higher level of competition than you would see before, because everybody's in the exact same meeting and has the same opinion, maybe differing or the same opinions, so that you have very robust discussions that may lead to a longer and more intense diligence, if you can believe that. I think the diligence process is already pretty intense, but it just seems to keep getting deeper because now we have, more eyes on it.
Thank you, Marcy. Wes, you want to add something to this?
Yeah, so with our program in March and April at the peak of COVID, we basically said we're not going to commit to any new managers. And then after a couple months, we said, okay, this looks like we're going to be in this environment for a while. What we will do is we will commit to new firms where we've met them in the past. And so that's still where we stand today. There are new managers where we'll do Zoom calls with them. We'll get to know them, but meet in person, because I think, to Marcy's point, it's very challenging to commit to a 10-year fund when you've never met the people in person. It's a little bit like, I don't know, I guess getting married to someone that you've never met in person. That's pretty challenging. So yeah, I definitely think it's a harder environment than pre-COVID. And I think, to Marcy's point about Zoom, I feel like everyone wants to do a Zoom call, and there's sort of no reason, there's no excuse, right? I can't say I'm traveling, or I can't say I'm in an in-person meeting, because we don't have any of those anymore. So I feel like we're doing a lot more Zoom calls, and Zoom is challenging because you're looking at the camera the entire time, versus when you do a phone call, maybe you're checking emails, or you're doing other things during the downtime in the calls. And so yeah, number one, I would say the environment, I think, is more challenging for new managers, and I think it's also more challenging for LPs, because there's a lot more stuff coming our way, and there's not a lot of excuses as to why we can't take meetings.
Thank you, Wes. There's another question came in on a similar topic. How has the due diligence that you perform on alternative investment managers changed in the current environment? It's a little bit different from the new manager, this more on existing managers. Can we address that one as well?
The process of diligence for an existing manager is not different than what we would do on an emerging manager. And so everything's moved to Zoom. We have just all-day Zoom calls with our managers, and we're getting the same type of information. We're talking to the same people for reference checks, whether it's company CEOs, CFOs, other LPs, every investment professional within a firm. So I would say it's remote, and it does seem to take a lot longer the way we're doing it right now, but substantially it is the same.
Thank you, Marcy. Wes, anything to add on your end?
Yeah, I agree with Marcy. If you think about what an LP does all day, we're reading documents, we're talking on the phone, we're working in spreadsheets, we're typing up information or memos for our team to review. So outside of the meeting in person component, there really isn't a dramatic change in our due diligence process. But as we talked about before, one challenge is that there's a lot more things coming at you. And I find myself wanting to be on Zoom and on the phone less, because I spend so much time on it now. Whereas before, that wasn't an issue. So again, we do a lot of reference calls, but sometimes when it's that incremental call that you might have done on a fund in the past, you might not do that now just because you don't have time, or you're just tired of being on the phone or Zoom calls all day.
Thank you, Wes. Jen, do you want to comment on any of these two questions from the ILPA perspective? What do you see?
Sure. I mean, and no question, we've all been living in Zoom. To Wes's point, I think we're all suffering some degree of Zoom fatigue, and we're also all meeting more internally than we ever have before. I would say there are some silver linings worth pointing out. One being that, even though it's really hard for new managers to get access to LP capital, to get time from LPs who have Zoom fatigue right now, the fact is that we're not traveling. So, LPs are more accessible than pre-COVID. But I'd say a couple of other things have come to light in this area as far as due diligence. One being that LPs may be getting more time with the junior members of the team on the GP than they did previously when they were doing on-sites in person, where you might have gotten a lot of concentrated time with the senior members of the team, but maybe less time with the junior members, who can be a more enlightening source of information for LPs. Another being that the referencing process, you can do more reference calls and probably are doing more reference calls to really get that insight, nuanced insight into GPs that you may not know as well. And in some cases, if you're investing with GPs that maybe you knew pre-COVID, but you don't have the benefit of an on-site diligence visit, you're going to be seeking out more of that information from your network of trusted LPs and seeking out those peers to get their take on the manager, filling in those gaps that you normally would be doing on site. But for the most part, I think LPs are not yet really comfortable with a start to finish, completely virtual, no previous interaction, commitments to new managers. I heard from my very first member today that they had done one deal with the manager. They had never met in person pre-COVID, but it was really because it was a manager within a very specific strategy they were looking to add to the portfolio, opportunistic credit. It was a manager they'd been monitoring for some time, just hadn't met with previously. But I think that's going to be a pretty rare occurrence for some time until LPs really get comfortable with, again, that start to finish virtual only diligence process.
Yeah, Jen, I think you pointed out some great benefits. I think one other benefit we've noticed is that every team member can join on-site diligence. So for some funds in our portfolio where other team members have spent less time with them, they're able to zoom in to the on-site diligence session for an hour or two and spend more time with the team, which I think is an added benefit to the way things are working today.
Thank you. Thank you, everyone. Looks like we have enough time for one more question. And here it comes. Managers are currently more challenged than ever in arriving at reasonable investment valuation that will approximate the ultimate exit. How does this weigh into LPs' cash management processes? Do they apply assumed discounts and reported marks in order to stay conservative and prudent? Let's start with Wes.
That's a great question. I feel like managers today are better at valuations than they were 10 or 15 years ago, just because there's so much information that's available. And we find that typically managers are selling assets for more than they have them marked, rather than less than what they had it marked for the previous quarter. So no, we don't discount valuations. And I think for us, it seems like a bit of a dangerous exercise. I mean, we ensure that the valuation methodology is sound, but I am not a valuation expert. We do like it when GPs use third-party valuation experts to come alongside them in terms of their valuations. But we've even seen a lot of our venture capital firms, they'll take a 10 or 20% discount to the previous round just to be conservative. So, I think for us, we feel pretty good about where valuations are in terms of reporting. And again, assuming there's not another pandemic or second wave, we think the ultimate exit proceeds will largely be in line with the most recent valuations.
Thank you, Wes. Marcy, would you like to add to this?
Yes, I do agree with Wes that evaluations and valuation processes that our GPs have in place are better than they have been in the past. I think a lot of people have extremely robust processes. In general, if we would have a reason to believe that a GP's valuation did not reflect fair market value, we would change that valuation. I have to say, it's very difficult to affect that. We do that in our direct portfolio occasionally, as Anthony knows. But with the fund portfolio, with really thousands of companies, it's very difficult to get that information so that we could make that judgment and say, hey, this does not reflect fair market value. So you would not really likely to see us do that. The one thing I would just add to the discussion is during the GFC, for buyout managers, it took a couple of quarters for you to see the declines in valuation coming through. In venture managers, it took even a little bit longer. We've broken it down and looked at it by asset class. It took somewhat 3 quarters to a year in some cases to see valuations come down. And I saw the same thing happening this time around, where a lot of the buyout managers have extremely robust processes in place, where it's to the point where the investment team does have some input, but not a tremendous amount. They have a valuation team that is separate from the investment team. They have their public comps, their transactions, precedent transactions, and they just put it through the paces. And the valuation is what it is based on the EBITDA of the company. So we did see significant, in my opinion, write-downs in Q1 toward the end of Q1. However, we did not see that in the venture space, and of course, the tech world behaved a little bit differently if you look at the public markets, but there was a delay, and my sense, based on talking to our venture managers, is they were waiting to see a longer-term decline or a more permanent decline in the market before they would move, because they can use OPM or last round pricing when striking their valuations. So we didn't see it flow through as quickly there.
Thank you, Marcy. It looks like we're out of time. Thank you so much for joining us today. And again, thank you to the panel for their participation and insightful commentary.
We hope you enjoyed this panel session. The videos of the concurrent sessions will be made available after the event. Please visit the Summit Portal lobby to take our brief industry questionnaire for a chance to win an iPad Pro. At 2:30, please be sure to visit the main stage and click to launch the live Fireside chat hosted by our CEO, Charles Weinstein, with Donna Brazil and Karen Hughes. Thank you.